Welcome back to Stocklabs. Another market recap. Just wrapped up option expiration week for November on the 18th, and it was kind of a soft week for markets. Yeah, we're kind of expecting coming in that the rally was not really built on anything other than just people trying to front run the Fed and all of this stuff like that. And this week we hopped around to start the week, attempted a bit of a up move in the middle-ish of the week, and then just gave it back and closed kind of fractionally down. Indices, Dow was the outperformer, down 12 bips. We had the S&P down 6/10, Nasdaq down 1.1%, IWM down almost 2%, 1.75%. Crude, big dump this week. Crude has really fallen apart as a trade, even though the oil and gas stocks haven't been too bad. They haven't really gone anywhere, but they, with the crude, I think is down to, I don't know, it's got to be down, I don't know, 30% or 35% off the highs, maybe more, 40% off the highs from the summer. So, I don't know if people are front running some kind of pivot from Saudi Arabia, or if there's SPR releases still ongoing or whatever. But this trade is sticking sort of with its historical seasonality, being weak this time of year more than anything. Bonds kind of outperformed, up 1.8%, not too bad. But for the most part, soft week. We had there wasn't much action on a directional basis this week. Our leadership stocks were a bit, I think, mixed. Yeah. So Google and Apple outperformed. They're both up 1%. Underperformer Tesla down 8%. This is really, I think like $200 a share was a bit of a line in the sand for a lot of people. Broke down below that, and we're kind of just trading in $10 increments now on this one till it bottoms probably. Amazon also down 6.6%, Nvidia 5.6%, and the rest were more or less in line with S&P and Nasdaq. So not a whole. A couple big down ones, a couple outperformers. The rest kind of in the middle. This is kind of a normal-ish week for how you would expect this group as a whole to perform. But yeah, nothing to really go off that. Breadth with our industries: basic materials underperformer, down 3.5%, healthcare down 3%, tech down almost 2%, utilities outperformed, up 1.25%. Starting to see utilities find their footing again after they really puked the utilities up. Utilities really puked on the last leg up of that rates went up, but have since sort of found their footing as the rate risk is still there, but it's diminishing in comparison to, I would say, just general recession risk. And utilities, they're safe, they pay you dividends or whatever. So they're finding some flows again finally. Services, industrials, financials, consumers, they were all kind of just market perform. And then not too many industry, actually, okay, one industry, metal fabrication, up 5% on a median basis, is nothing to really get excited about. And on the downside, we have some more sectors, but okay, and actually they are like kind of riskier sectors. We've got EVs, we've got a bunch of healthcare related stuff in here. SaaS, applications, software has been terrible all year, but we sort of thought that it may have found a bottom one point earlier, but this is giving back a lot of the recent bounce, so we'll see. Cannabis always down, but whatever. Yeah, on an industry basis, the breadth wasn't horrible, given that the market was just generally down. But you do see there was there was some bias to the downside even all of these ones, they're not 5%, but they're right there, like 4% or whatever. On the upside, it was like there was one at 5, and then the rest were like way below, like 3, 2, whatever. So sell side, sell pressure on, by industry breadth, I would say. Um, and then breadth on a market cap basis, we got 1 to 5 billion. This was a split. Down 2.25 for 1 to 5 billion, so worse than the Russell. 5 to 10 billion, down 1.8, basically in line with the Russell. 5 to 10 billion, down 1.3%. 50 to 100 billion, down 6/10. Kind of not too bad, actually. And over 100 billion, up 3/10. So you're seeing this is starting to develop a bit of a pattern where the larger cap equities are kind of consistently outperforming again now. We saw this a lot of last year in 2021 before everything dumped out. But for a while we had several months where the only place you could make money was in large cap and mega cap, terra cap type stuff. The smaller stuff was completely abandoned. And if you stuck with the larger stuff, then it was like, everything was fine. But if you were in the riskier stuff, it was like you were getting walloped every week. So this is sort of starting to remind me of that, where, there's a clear bifurcation by market cap where money is going to go. So you can see 100 billion plus was actually up on the week and actually was better than the Dow. So, and if the NASDAQ was down, 1.1%, you can figure anything non-tech that is 100 billion cap higher is where the money is, kind of finding its way. So, people aren't ready to pile back into the NASDAQ or tech stocks and all that stuff, but they are willing to put money to work in other large, presumably quote unquote safe companies. So we'll see if this pattern sort of keeps going. But that's what it's looking like at the moment to me. For intelligence for the week, okay, we have quite a few more on this list than usual. Got bear China, okay. Bullish energy, bullish big oil. Got Brazil, I'm going to ignore. Okay, SQQQ, short NASDAQ. It's not encouraging. Bull energy again. Bull mid caps. Mid caps probably have some room to catch up from last week. Oil and gas again. Robotics, whatever. China. Okay. So I would pay attention to bear China and the short NASDAQ on here. If we reverse this for the downside, okay, we got some Brazilian ETF. I'm going to ignore that. SARK, bearish. Bearish Cathy Wood ETF is bearish, which means bullish ARK for this week. Kind of would find that hard to believe if the Nasdaq was gonna go down. So it's got to be one or the other out of those two. Got some sort of EM income. I'm gonna ignore that. Bear energy is bearish, so bullish energy again. Looks like the energy trade is where you kind of want to be this week. TMF, so this is bull bonds, which is bearish. So bearish bonds rates are going to be going up. That would sync up with the NASDAQ going down. I mean, NASDAQ has basically cowered at every move up in rates, has shown little appetite for trying to overcome that. So yeah, if rates kind of start to creep back up this week, you might see the NASDAQ really spill, at least into Thanksgiving or right after Thanksgiving. We've got Baltic Dry Index, bearish. I don't know anyone that follows Baltic Dry Index. Not really that important. Total return fund, don't know what that is. And actually, I'm going to ignore all. Okay, here's another bull treasury TF, which is bearish. So we've got materials. Yeah, I'm just going to ignore all this stuff at the bottom. So, yeah, I mean, it looks like kind of the energy trade might have some life this week. NASDAQ, not going to go anywhere. Kind of bearish NASDAQ and bearish bonds, which is more or less the same thing as bearish NASDAQ. Those trades have been in lockstep with each other for the week or for the year. I mean, I know a lot of people are looking for a big rally into Thanksgiving. I mean, this has historically been a very bullish week for markets, but historically the market has been bullish. So, I mean, it makes sense that holiday weeks during bull markets are bullish because everyone's happy. You just go out there and buy stocks, you squeeze the shorts eyeballs out, and like everyone laughs about it. But in this tape, I'm really not seeing some like big bullish move this week. I think kind of more likely you see another down move. Maybe at best you see some chop. I mean, a lot of probably a lot of options and stuff expired. This past Friday, so the market's kind of going to be free to move a little more uh, than it was the last week or so, and you have to guess that there were a lot of puts that expired. So once people start putting on that put exposure again, um, market's gonna drift to the downside, I would think. So we'll see. I mean, it could maybe everything is just hunky dory and history plays out the same. We go bullish into Thanksgiving, but I sort of see a scenario more like, um, not too dissimilar from 2018 around Christmas time, where we really beat the brakes off the market straight into Christmas, and then everyone on that Christmas Eve, Christmas Day was just talking about how terrible the market was, and that was basically the bottom for like a couple of years. I'm not saying we're putting in a multi-year bottom right this week, but it has like that sort of same feeling where the market just slides straight into Thanksgiving, and everyone is just talking about how terrible the market is over Thanksgiving, because what else are you going to talk about over turkey and cranberry sauce and all this stuff? So, yeah, wouldn't be pressing too much risk in the for this week. Just either leave it alone, or you could sell into it with if there's like some downside momentum or something like that. So, yeah. Other than that, short week, so no reason to blow yourself up with like 2 days of trading, 3 days of trading. Um, and yeah, other than that, enjoy the holiday. Hope you have fun, friends and family, and all of that. And we'll be back next week to check in. So talk to you guys later and have fun out there. Bye.